Chapter 1. Introduction to CIBIL Score in India. In India's fast-changing financial landscape, your CIBIL score has quietly become one of the most powerful numbers in your life, even more influential than your marks in school or the kilometers per liter your bike gives. Whether you want a home loan, personal loan, car loan, or even just a credit card upgrade, this three-digit number often decides whether you'll hear approved or rejected of your credit history, ranging from 300 to 900. It reflects your past borrowing behavior and repayment discipline. The score is generated by TransUnion CIBIL, India's oldest and most widely used credit bureau, based on your credit report, also called a CIBIL report. Here's the general score interpretation. Why CIBIL score matters. Think of your CIBIL score as your financial reputation. Just as your reputation among friends is built on trust, your credit score is built on how trustworthy you are with borrowed money. When you apply for a loan or credit card, banks and NBFCs, non-banking financial companies, pull your CIBIL report to check. Will you repay on time? Have you defaulted before? Are you already burdened with too much debt? A good CIBIL score doesn't just get you approved faster, it also gives you better interest rates, higher credit limits, and access to premium financial products. Calculates the CIBIL score. TransUnion CIBIL is one of India's 4 RBI-approved credit information companies, alongside Equifax, Experian, and CRIF Highmark. However, CIBIL score has become a generic term in India, much like Xerox for photocopies, because CIBIL is the most popular and widely used. How the score is generated. Every time you use a credit card, repay a loan EMI, or even miss a payment, your bank reports this activity to CIBIL. Over time, these records create a credit history, and CIBIL uses it to calculate your score based on several factors: payment history, whether you pay on time; credit utilization ratio, how much of your available credit you use; length of credit history; types of credit, secured versus unsecured loans; number of hard inquiries, loan credit applications, RBI and lenders. Since the Reserve Bank of India has made it mandatory for banks to check credit history before approving certain loans, the CIBIL score has become a standard checkpoint in loan processing. For lenders, it reduces risk. For borrowers, it means past mistakes can haunt future borrowing. The good news: unlike your school grades, your CIBIL score isn't fixed forever. Even if it's low today, you can improve it systematically. With disciplined financial behavior, some patience, and smart credit usage, your score can climb into the 750+ range, opening doors to easier approvals and lower interest costs. Number 2. Understanding how CIBIL score is calculated. Before you start improving your CIBIL score, it's important to understand how it is calculated. Think of it like repairing a bike. You first need to know which parts control speed, balance, and fuel efficiency before you start adjusting anything. Similarly, in credit scoring, you need to know which factors matter most. Payment history, 35%, the king of credit score. This is the single most important factor in your CIBIL score. If you have always paid your EMIs and credit card bills on or before the due date, you're already doing well here. What counts as a red flag? Missing even one EMI. Making only the minimum payment on a credit card for too many months. Loan defaults. Settling loans for less than the full amount owed. Why it matters. Lenders see past payment behavior as the strongest predictor of future repayment. Quick tip: set up auto debit for EMIs and bills to avoid forgetting payments. Credit utilization ratio, 30%. The balancing act. Credit utilization ratio, CUR, is the percentage of your total available credit that you're using. For example, credit card limit, Rs 1,000 current usage, R 4,000 CUR, 40%. Why it matters. A high QR signals to lenders that you may be overly dependent on credit, which increases risk. Best practice: keep your QR below 30% at all times. If your limit is R 1,000, aim to never use more than R 3,000 in a billing cycle. Length of credit history and credit mix, 25%. Your financial CV length of credit history measures how long your oldest and newest credit accounts have been active. A longer history, more data, more trust from lenders. Credit mix refers to having a combination of secured loans, home loan, car loan, unsecured loans, personal loan, credit card. Why it matters? Lenders prefer customers who have shown the ability to handle different types of credit responsibly over a long period. 4. Other factors, 10%. The silent score influencers. These include hard inquiries. Every time you apply for a loan or credit card, the lender pulls your report, creating a hard inquiry. Too many in a short time can hurt your score. Number of accounts. Having too many open accounts, even unused ones, can signal higher potential risk. Common myths versus facts. Myth. 1. Checking your own score lowers it. Fact. Soft inquiries, checking your own score, do not affect your CIBIL score at all. Myth 2. Closing unused credit cards improves your score. Fact. This can actually lower your score by reducing your available credit limit and shortening your credit history. Myth 3. One late payment doesn't matter. Fact. Even a single 30-day late payment can cause a significant drop, especially if your score is already low.